Pre-recorded. The airing of this program by this station is not an endorsement or recommendation by the station of the products or services discussed in the program. The station does not guarantee the results of any investments made by a listener to this program.
The Word on Wealth with Gary Quackenbush is sponsored by the Word on Wealth Radio Network. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary is a San Diego financial solutions attorney, protecting people like you. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. Now,
you're live.
Hey, everybody. Welcome to the Word on Wealth. This is Gary Quackenbush, your host, and I am glad that it is a Monday. We could start a new week now and get moving forward. We've had some good weather. Oh, man, there's a lot of good news and there's a lot of bad news, some sad things going on in the world right now. And I don't know, it gets me kind of, makes me really want to figure out if we're ready for that day. You know, I was talking to just a guy this morning, and it was like, you know, we just kept talking about, well, what if I became incapacitated? What if that time came, that big time? You know, what if I pass away? What will happen? And we go over that. That's what I do. Talk to people about their estate and what happens and how do you manage it? How do you make sure that your loved ones are the ones that they're cared for in the event of your death? And, you know, yeah, it's a radio show on this stuff. Crazy, huh? But we have the ability to, you know, give information to a broad sector of people. You know, I've done this where I've done estate planning seminars all up and down the state of California, webinars all over the place. You know, I've done it a lot because trying to get the word out that there is a way to do things right, and that is have your estate put together so that in the event of your passing, the last thing people are going to have to really worry about is what about finances and your property and what you wanted done and who is in charge, and, you know, getting all these costs and expenses and everything. There's so much of it is taken care of if you get an estate plan put together. And that's my job. That's what we're here for. That's why we have the Word on Wealth. If you have any questions for me, call me 888-344-1170. We do have lines open today, right now. Call 888-344-1170. A couple of things. Today is also the half hour. We're going to have Rich Mathurin of GQ Law, and he's going to come in and talk about tax situations. If you haven't filed in a while, if you have a tax problem with the IRS or maybe even the California Franchise Tax Board, or maybe business taxes, and there's money that is owed, it's a big topic. There's a lot of people have situations with taxes where they're just having trouble paying them. And that's what we're going to be addressing as we go through as we talk to Rich when he comes in the second half of the show. We know, I mean, all you have to do is like open the newspaper, drive your car somewhere and turn on the radio, look on the internet, check the messages on your phone. There's stuff happening all over. None of this is new. This is not, you know, having Silicon Valley Bank go into receivership. It's not the first time. Having, you know, the FDIC chair, you know, come out and say, oh, we're going to cover these people and pay more money than we're supposed to. And I mean, and having the government change and move things around. This is not new. I mean, if you guys have been around a while, this stuff is not new. Okay. Financial problems are not new. Having crazy stuff going on with your tax monies owed and all that kind of stuff. None of this is new. It's just stuff that we have to decide how we're going to decide. We have to decide what we're going to do and how we're going to deal with the news that we hear. You know, are we going to go into some, you know, anxiety for the future, or, you know, are you going to be worried about the past and just be, you know, freaking out of what you've done that is not worthy or good enough or whatever? None of that really matters. It's we're here and now and trying to deal with these things. So let's talk about who should have a revocable living trust. Okay, first of all,
Gary, what I think we should talk about is the subject matter of our next caller. We have Larry from Poway.
Larry from Poway. Hello, Larry. This is Gary. Welcome to the Word on Wealth.
Hi, Gary. Thanks for taking my call. You did my LLC for me, and you've reviewed my trust, but So now I've acquired a brand new car, first one in my life, brand new car. And when I financed it because it was 0% interest, they put my name wrong on the title. So can we still, I two questions. I should probably put that into the trust. And how do I do that if it's worded incorrectly on the title? Because I've talked to it's a big deal to change the holding because of the lender.
Oh, interesting. Okay, so the lender, so the name is wrong on the trust. You have to put it in, I'm sorry, the title. Okay, so name is wrong. Interesting. I mean, they're going to have to change the name on your title. I mean, that's their fault. And if it's difficult, that's really still, it's got to be done. I mean, the dealership usually is the one that deals with all the DMV stuff. As far as putting the car into the trust, what you do normally is going to be how you register the car. So if the car is registered, you know, you just did it brand new, so that means it was just registered. You may even have just the temporary plates on it, right? It's not really finally registered into your name. So at the point you're at now, it's really difficult to put it in your trust. What you would instead do is you would rely on your assignment. There's an assignment in your trust that says that you assign all of your personal property wherever located, including automobiles and furniture and furnishings and monies, that you transfer them to your living trust. And depending on the value of the car, that should cover it. So what is the value of your new car?
Well, I think we paid $45 for it,
Okay.
but because of this, I was thinking I've also got an old classic airplane that's worth probably 45 or 50, and I've also got a motorhome that's worth probably 30. So that's getting me up close to that 166. So I probably need to put all that stuff in the trust. Is that correct?
Yes, I would. Yes, that would be what I recommend, is start working on getting the car with the financing. That might be more difficult, but because you've got all those other things, your airplane and your mobile motorhome, you probably want to start by getting those in so that number is down lower. You know, that last thing I'd probably do, if with the financing, they didn't let you purchase it into the name of the trust because it was financed, which is totally fine. But I think your other assets, I would be more concerned about them. With the way it works with the motorhome is you get a change of ownership form from the DMV, and you fill it out and explain that it's, instead of it being Larry, it's going to be Larry, trustee of Larry's Family Trust, that's going to be the owner of the car, and the DMV will let you do it. It's just a form. It's a change of ownership form, and do that for the airplane and for the motorhome. And if you have another car, I would do the same thing so that at least you have most of your stuff in the trust. I think that would be the best way to go.
Okay, so I'll give your office a call and find out when we can do it, and I'll start getting it done. Thanks.
That sounds good. Larry, thanks for giving us a call. That was Larry calling from San Diego here on the Word on Wealth. We do have lines open, 888-344-1170. If you have a question for me, give me a call, 888-344-1170 here on the Word on Wealth. To get information, I've got a lot of free information on my website, which is gqlaw.com. GQ, like Gary Quackenbush, LAW, like law. gqlaw.com. You can go on there and there's a Living Trust Basics book cover. It's an ebook. So the only thing that's online is a picture of the cover. In fact, I have book covers in my office and it's just a cover. The front and back are the same page. And what you do, you go onto the website, you find the book that says Living Trust Basics. It's a white cover. It says Living Trust Basics on it. You click on it. It asks for your name and your email address, and then the book will be sent to you email as a PDF. So you can read it, study it, learn about it. It's in outline format. It's not, it's not a long book. It's really very short. It's only 20 pages. It is an outline format. So there's a lot of materials in that 20 pages. It's based on the seminars that I've done all up and down the coast of California, all up and down the state, telling people, tax professionals, individuals, what estate planning is all about and living trust. That's in my book, Living Trust Basics, free on my website, gqlaw.com. All right, coming up next, I have some questions like, who should have a revocable trust? Do some people not need one? Let's explore that. Coming up next here on the Word on Wealth.
You've got questions. We've got answers.
I just sent you an email, just a little reminder. My boss just reminded me the
of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQ Law.
You're live.
Welcome to the Word on Wealth. You've got me, Gary Quackenbush, and coming up at the half hour, the bottom of the hour, we got Rich Mathurin from GQ Law, and he's going to come in and talk to us about tax problem solving. Might be situations that you have, or your friends, or a loved one, or somebody. We're going to talk about business and personal and answer your questions. And on that line, if you have a question for me, call me 888-344-1170 and be part of the show. Ask me a question, I'll answer it online with you right here on the show. Who should have a revocable trust? So let's see. What about, so I'm going to give you scenarios. Husband and wife, kids with a house, cars and cash. Oh, that's easy. Yes, of course. Because of kids, number one, and because of house, number two. Okay. Number two, what about a person that is single, divorced, has some kids and a house? Answer? Yes. Why? Well, number one is the house and number two is the kids. So those are, you'll see, those are a couple of big reasons. All right. What if then I'm going to turn around and now we're going to have husband, wife, no kids. Okay. 2 houses and a retirement account. Do we need a trust? And the answer is yes, because non-child beneficiaries are going to be not, if you die and you have a couple of houses and it's you and your wife, you and your husband, you guys both die with no children, where does your money go? It goes all over the place. It goes through your bloodlines. Okay. Your lines of consanguinity. Your bloodlines are children if you have them, but you don't. We just said you didn't. Then it's going to go up to your parents, half to the wife's parents and half to the husband's parents. And the parents, if they are dead, it's going to then go through the parents' bloodline as if it were the parents' money. So that means it's going to come back down to you, which it can't because that bloodline is gone, right? It's cut off by your death. And it's going to go and look for your brother and sister, if there are any. And if it finds a brother's bloodline, because it goes to brother who's dead, but he left children, then his kids are going to get 1 share. And if it goes to sister and she's dead, she's alive, then she gets the share. So what's happening is it's just going to keep tracing blood and it's going to end up going out. You know, sometimes if you have no living siblings who had children, then it's going to go to your grandparents. So you have 4 of those. 2 on mom's side, 2 on dad's side. Maybe there's a divorce in there. Then you're going to have 6 on dad's, 6 on mom. So you get to where it's really spread out thin. But with when you don't have children and there's no kind of natural flow of money from you down to your children, it's really important to have a living trust to designate where your stuff goes, to say who gets what. Now you might think, what about just a will? Let's just do a will because I don't really care if it costs money. I don't care if there's probate. Fine. The attorneys can make some money. So can this, the administrator, and so can the courts. Fine. I'm good with that. Okay. But you still have the situation in probate where we're going to have to name people that are going to be doing the job. And it just gets to be kind of like, hey, what a good process, making a lot of money for all the professionals because it's a super expensive process. But wouldn't it have been better to move it more smoothly to be able to pay out to your beneficiaries without having so much hassle? Okay. Now let's go to a different situation. Person is single, no kids, has a house and a car. Okay. So this is single, no kids, house and a car. Trust, yes or no? Yes. I know, common theme. So yes, because there's a house. This thing is going through probate. I mean, it's in California. The house is going to be, if the house is worth more than $62,000, which almost all houses in California are worth more than $62,000, it will go through probate court. So you die, you're single, there's no spouse, there's no kids the money's going to. Instead, it's going to go to your heirs, which means it's going back up to the bloodlines. It's going to go up to mom and dad, then go out down through mom and dad's bloodlines, which means it's going to go to your siblings if you have any, or your nieces and nephews, if you have any. If you don't have siblings or nieces and nephews, then it's going to go to aunts and uncles, if you have any. And then it's going to keep going up that way. Okay. So still get a trust because you have a house. You still have some money. Give it to a charity, a school. Put it somewhere where it's going to be useful. I mean, you earned it. It's your money. Do with it something important. Okay. Let's see. Dun, dun, dun. What about, okay, here's a really interesting one. And so listen up on this one. It's an example, I think, of a way to get have a trust, and you may not think it is that conventional. So you have a husband and wife, and they have some little kids. They don't own a house, they're renting, but husband has $1 million of life insurance, and so does wife. Okay. Trust, yes or no? I mean, remember, life insurance, you can just check the beneficiary designation, and it says, when I die, give it to my kids, or give it to my wife. Unless she's dead, then give it to the kids. And you can do that. That's fine. And as long as your kids are old enough to handle the money, that's totally fine. If they're minors and they struggle holding, managing money, then you don't want that. All right. So what you do is you make it so that the life insurance after your death pays into your living trust. It goes into your trust, and now you have an estate. So before you died, you're thinking, I don't have an estate. I have no money. I don't have a house. I've got some retirement, whatever. It's just not that much, but you got your kids. Life insurance, that's your estate. And I know it doesn't go on a balance sheet, but this is an estate plan. We're talking about your survivors and how they're going to manage without you here. And your life insurance is your estate. That's your wealth. So when you die, that $1 million goes into the trust, and now your wife and kids have some money to live on. So yeah, super important. Single parent, $500,000 house with a $400,000 loan. You're thinking, oh man, when that house sells, there's going to be $50,000 of net income. Who cares? Well, it's going to go through probate, even though the house is worth $500,000. The loan is $400,000. So the net estate is 100 or less because of cost of sale. But we're talking about gross estate. When we talk about probate, it's the gross estate. $500,000 house. We don't care that there's a loan. We don't care that there's not much equity. It's a $500,000 house. It has to go through. It's going to have to go through probate if you didn't have a trust. And it's going to go, the fees in the probate are going to be based on the $500,000 house. Okay. Probate fees are always based on the gross value of the estate. So that's a problem, right? $500,000 probate estate. That means it's going to be about 5% fees for the attorney and about 5% for the fiduciary. Let's just say 6% between the two. So now you're talking $30,000. Your value, you just ended up spending $30,000 in administrative costs. So your value is not going to be worth that much. It still is going to go through probate because the courts in probate are looking for the gross value. They don't care about loans. It's not considered. They're going to get paid, but the estate being administered and distributed and handled, that is worth the $500,000. Okay. Let's see. Is there a no? Okay, here's one. Single, no kids, no house, life insurance. And do you need a trust? That's the first no. Single, no kids, no house. You just have life insurance. No, because life insurance kicks in when you're dead. You don't have anything while you're alive. There's nothing to plan, nothing to give people. You would do a will, a simple will, which would be perfect. And then a healthcare power of attorney, so that in the event of your incapacity, somebody can make healthcare decisions for you, because somebody's got to be able to do that. So you need a will and a healthcare power of attorney. So that looks like, what about college kids? I mean, do you guys have college kids that are going off? Maybe you have college grandkids. Not me yet. But college kids going off to college need a power of attorney, right? They need to give you, the parents, the power of attorney, because if they don't, who gets into their bank account? If it's a joint bank account, you can. But what if something happened to them? What if you need to talk about the rental agreement they have, or there's an issue with, you can't figure out where your kid is or something like that, and you're trying to call people or talk to people at school? They will not talk to you because the kid's over 18 if they're going to college typically. And so they're over 18, they're adults. and the college will not talk to you. They don't care that you are their parent. They just want to know, do you have permission? And if you don't have permission with a written agreement, then you're not going to get permission. They're not going to talk to you. So here's a scary story. So what happened is son goes off to college and can't get a hold of him. We've heard he's had an accident, that he's injured. We can't find him. We call up to the healthcare center and say, hey, I am my son's father, and I would like to talk to him. And we believe that he is there at the health center with you. And they say, oh, well, that's nice. But they can't say, oh, I'm sorry. Yes, he's here, but we can't talk to you, because that's exactly what you want to know. Is he there or not? They just say, I'm sorry, we can't talk to you. By the very fact that your son is matriculated at this school, it means he's over 18. And if he's over 18, he's an adult. Do you have a power of attorney that you can send us, Mr. Quackenbush? No, I don't. All right. So they don't want to talk to me because they know that I don't have a power of attorney and my son's an adult. So I can't even figure out where he is. So I have to call his roommate and say, hey, where is my son? Oh, I don't know. Would you mind checking the health center? So he trots up to the health center, grabs his cell phone, stuffs it in my kid's face and says, hey, it's your dad. Okay. Is that terrifying as a parent when your kid goes away to school and you can't talk to them? Yeah, it really is. I've done power of attorneys for my friends quite a bit. It's like, hey, if your kid's going to school, get a power of attorney and healthcare power of attorney and financial power of attorney, because you're going to be sending them money, right? Yeah. Joined on their accounts. Yeah. Well, what if something happens to them? You need to have power of attorney. I just think that's a good plan for kids that are going away to college. Okay. So you get my point. Who should have an estate plan? The answer is almost everybody. Everybody should have an estate plan. Who should have a trust? A lot of people. In California, people with wealth of over $1 million, only 40% have a trust and only 50% have a will. That's horrible, you guys. We got to change that. Get a will, get a trust, get your life taken care of, get your estate planned. I'm happy to do it. 855-500-TRUST. Call up, get a free consultation. I'd be happy to meet with you. I want to see your face. I want to meet you. I want to talk about your estate plan and figure out exactly what would be the best for you. And when we're done with the initial interview, I want you to hire me and I will do your estate plan within 2 weeks. Okay. If you want it faster, that's a possibility. We can talk about it, but a couple of weeks is usually our turnaround. So we'd really love to have you guys come in and do an estate plan with us. It's 855-500-TRUST, or go to my website, gqlaw.com, GQLAW.com. Go to the website. There's a contact us form, and it will tell you how to get in contact with us. It's literally click on it, put in your email address and say, hey, I want to talk about an estate plan, and we will get back to you and talk to you about it. 855-500-TRUST, GQlaw.com. Coming up next, we got Rich Mathurin talk about taxes right here on The Word on Wealth.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We are here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
With that
ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com. 855.
You're live.
Hey, welcome to Word on Wealth. This is Gary Quackenbush, and we got Rich Mathurin. Rich, welcome to the show again.
Great to be here, Gary.
You know, Rich has he's been on this show every Monday with us, and we always have him to be able to talk about taxes. What he does at GQ Law is he deals with tax problems. So I thought, you know, let's get Rich on here as our regular Monday guest. And sometimes, you know, we're in tax season, and like right now, the IRS, because of the, you know, basically most all of California, the tax returns aren't even due until October 15th. The state of California has agreed to go into, you know, to agree to the same thing. So if you're in a disaster zone, which is like California, I mean, it's San Diego, Imperial County, LA County, it's like everybody within the sound of my voice, they're October 10th, which is very odd. But the funny thing, there's just kind of some tax trivia. The funny thing is that if you have income in another state, like we do, like our tax guy, Craig, does a lot of out of state tax returns for clients that have, you know, money out of state, or they even live out of state. So the federal deadline in California is October 15th. But if you have a client that actually needs a tax return in another state, they don't qualify. So you still have this tax season, April 15th deadline. That's why Craig is, you know, kind of working his rear end off right now, because I'm going like, Craig, what are you doing here? It's the October deadline, out of state clients. So they still have their out of state clients, and then they're going to have their clients going all the way through October. So
yeah, I do think tax preparers are happy about the new October deadline, though. I think it's made their life a lot easier.
Yeah, it stretched it out so they don't have to cram everything, you know, all into the what is it? Usually February, March, April, or there's hell months, I guess. But you know, they've been doing it for so long, it's crazy. So you know, the one of the things that kind of came up with dealing with tax problems, Rich, is I always have in my mind, and I have clients, you know, or, you know, people that will ask me, they'll say, well, I mean, do people really like not file their tax returns for 5 or 6 years? I mean, if people don't have a tax problem, they don't get it. They're going, oh my gosh, everybody should file their tax returns. We know that. But what are some of the reasons that they don't file? I mean, sometimes it's like 2, 3, 4, 5 years. Why don't people file sometimes?
I think that sometimes they have, you know, emergencies in their life, sickness or whatever. I think a lot of times they get behind 1 year, and they figure if they keep filing, they're going to just keep getting more and more behind. And I think, like we've talked about, the burying your head in the sand type of attitude. I guess some people think that, you know, if they don't really have 1099s or W-2s, that they can fly under the radar and maybe the IRS won't notice them. So those are some of the reasons that I think maybe some people are just willful, and, you know, I think we do have some people that, you know, feel that they shouldn't have to pay taxes and file tax returns. So I guess you can die on that hill.
Yeah, not in this office. That doesn't work anymore, guys. I mean, that's the fun thing about doing this for so many years is like, gosh, I started doing, you know, attorney work in the early 80s, and man, their tax protesting was huge then. People were saying, well, I'm not a U.S. citizen anymore. I've gotten rid of my social security number, and I'm not a U.S. citizen anymore, and so I don't have to pay taxes, which was always weird to me. I said, well, but if you got rid of your social security number, you don't get social security. I don't know. So there's kind of always these problems. I don't, my thing with tax protesters, it's like, you know, I've had people that will come in and say, the tax system is illegal and all that. And my attitude was like, so what? What do you mean, so what? This one guy was really mad at me. It's like, what do you mean? And you're not even a good lawyer. I said, well, whatever. What are you talking about? He says, well, the tax system is illegal, and here's why. And he goes through all that. And I said, so if you're going to die on that hill, like you said, if you're going to die on that hill, go for it. Just not going to happen in my office, because bottom line is the government collects taxes, about $13 trillion a year in income taxes, and that's how it feeds itself. And it's been doing it for a very, very long time. So if you want to be the one that says taxes are illegal and the government shouldn't be collecting $13 trillion in taxes, I'm not sure it's going to go very far. But I've seen people in prison for that. You go to jail for that. You go to federal prison, and then it's like, and then if you talk your kids into it, it's just a mess.
Yeah, there's a good IRS publication on that, where they go over that issue and
Oh, really?
deal with all of the arguments and rebuke them each. So I would definitely suggest filing your taxes, because it's not going to be a winning argument if you don't.
Interesting. Yes, I don't. It's not even like taking on Goliath. It's just like, I don't know. It's kind of like you live here in the U.S. You pay your taxes. I mean, don't be silly and pay extra taxes. I mean, for crying out loud, there's a lot of legitimate deductions and loopholes and stuff like that. And if you get a tax professional, if you're self-employed, you should not be doing your own tax returns. And I think everybody should be self-employed. You got to have some side gig. They get some more deductions. But let's go. So as far as, I mean, sometimes, people owe money and you think, gosh, it just seems kind of weird to owe tax money. If you've ever had that problem, you understand. Yeah, sometimes it just, you don't have the money to pay because of circumstances. But
Gary, let me if you are going through a hardship, you lost your job and you can't pay your like you had a job and you were earn money and you've got a tax balance and now you can't pay it. There is a solution to that. There's a currently not collectible status. You do have to show your cards, but if you're unemployed, the IRS will not, they will put you what they call in non-collectible status, and they will not do involuntary collections against you while you're in that status. So if you're unemployed, you're sick and in the hospital or whatever, there is solutions to that. But do not use I would not use that as an excuse not to file your taxes, because the consequences down the line could be really, really severe. If you have to file bankruptcy, those taxes, if the IRS does a substitute for return in place of the one that you did not file, those are not dischargeable in bankruptcy. Also, those taxes are usually much higher than if you did them yourself and you had your own tax preparer do them. Like I said, we've talked about this previously. I once had a guy that the IRS claimed he owed $60,000 with a substitute for return. Then when we had Craig do it, he ended up that the IRS owed him money. So, I mean, please, if you're going through a thing where you're unemployed or you're hospitalized or whatever, that currently not collectible might be a really good avenue for your situation.
So really, it's just better. The IRS, they're not evil. They're a collection agency. They're the largest collection agency in the world. They employ like 186,000 people, and they collect $13 trillion a year in taxes. I mean, they're really good at what they do, and there are rules and laws to pay. And so, what you're suggesting, which I just think is really the way, is if you owe, you owe. Just file the return, file it on time, don't get all these penalties and stuff, and then deal with it. And if it's going to be, you have to kick the can down the road, you have to delay it. There are legitimate legal ways to do that, but don't do it by just burying your head in the sand. Now, I've seen situations where, and what I want to talk about a little bit is, these are some of the things. We're talking to Rich Mathurin here on the Word on Wealth. He works for GQ Law. His job at the law firm is to deal with any tax problems, and he does a really great job at it. And he does a lot of other things here too. But we're doing the tax show today, so we figure we should talk about tax situations. But I wanted to talk. Some of the things is like, I want to talk about how the IRS can take money from people, like what they can get. So, I think I will lay out, like, let's say I owe money to you, Rich, and I owe the money and it's legitimate. So for Rich, if I owed a bunch of money to Rich, he would have to sue me. Okay. He'd sue me. He would file a complaint. He's going to have to pay money to file the complaint. He's going to have to pay somebody to serve me. I get served. I look at the complaint. And if I just flat out ignore it, then he's got to go and do a default. Then he's got to go to this hearing and do a prove up. There's all these things. If he wants to get money from me and force me, he has to go to a judge, go through the whole process. And it's going to take 6 to 9 months easy. Gets a judgment against me. And the judge says, you're right, Rich. Gary owes you $50,000, and whacks the gavel and says, he owes you that money. Here's my judgment. Then Rich has to go to the judge and say, oh, I'd like to collect it from Gary. The judge says, well, where would you like to collect it from, Gary? I don't know. I'd like to go after his bank. Where's his bank? I don't know. Well, come back when you find out. Then he does a judgment. It just goes on and on. There's all these things. And there are attorneys that do collections, and that's just what they do. But what I want Rich to describe is, instead of it's the IRS that you owe money to, do they have to go through that same process? So we're going to end up bumping up against the break, but just let's start it a little bit. Like, first of all, does the IRS have to sue you to get a judge to determine how much is owed?
No, they do not have to get a judge, file a lawsuit or get a judgment order after they get a default judgment. So they're the most powerful collection agency in the world. Because of that, they do not need to go through the judicial process to do involuntary collections against you.
Right. So they to figure out, but for the IRS to figure out how they're going to get money from you, they open up the book, and it's called the Internal Revenue Code. There's a whole section on how to collect money, and it doesn't involve suing you. It involves them giving you a notice that says you owe us money, and they go through this process, and it's called due process, but still it's administrative. No judge. And if you ignore them long enough, then they help themselves, right?
Yes, they can do garnishments, bank levies. They file liens. We should probably talk about that at some point. That's
Okay.
a very powerful weapon that they have against taxpayers.
All right. Well, let's do that. You're here with Rich Mathurin on the Word on Wealth, and coming up next, we're going to talk about tax liens. What are they? How does it work? How to get rid of them? What to do about them? Coming up next here on the Word on Wealth.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com.
Gary.
Out what's available, discuss your options, and figure out which ones to implement, what it's going to cost, how long it's going to take. We can get people out from under all kinds of tax problems so they can sleep again. That's our goal.
Request your free initial consultation. GQlaw.com. 855-500-TRUST. GQlaw.com. What?
$500-TRUST. GQ Law.
You're live.
You're listening to the Word on Wealth. Hey, this is Gary and Rich Mathurin, and we are talking about, gosh, here's what we're going to talk about right now. This is crazy. Is federal tax liens. And we kind of, when Rich and I talk about them, it's like because we deal with it a lot, and we just see them all the time. But then he mentioned, let's talk about liens. And I got thinking, federal tax liens they're way different than you think. So let's talk about federal tax liens. So tell us, Rich, like what, federal tax liens, like how do they come about? And then kind of like, so what? So what if the IRS has a quote federal tax lien against you? What does that mean? How does that affect us? So talk about the state, that kind of stuff.
My understanding is that if you have balance with them of over 10,000 or more, they automatically will file a lien in the county you reside in with the San Diego. Let's take San Diego, for example. They would file it with the San Diego County Recorder's Office, and that would attach to all of your personal property and assets in San Diego County. That would be your bank accounts. That would be your car. That would be your home. So if you wanted to do let's use your home because that's the simplest example. If you wanted to do a refinance or you wanted to sell your home, the IRS is there probably under your mortgage lender. It's a priority thing, who files their liens first. And they have to be paid off before they will release their liens and allow the refinance to go through or allow the sale to go through. One thing that I will mention is if you get into a payment plan with the IRS and you get your balance below, I believe it's 25,000, and you make at least 3 months of payments under that installment agreement, they will release the liens. But otherwise, you do need to keep that aware. They in bankruptcy, they will probably not be dischargeable unless the IRS feels like you're just totally, they're not going to be able to ever collect from you. You don't have any assets or income, but generally they won't be released in bankruptcy. Offer in compromise, they will be released. If you get an accepted offer in compromise, that does release the liens. But if you're in a payment plan or a non-collectible status or in bankruptcy, they generally will stay on.
So then just kind of a review is that the lien is it's the IRS. They determine that there's taxes owed. They've sent the notice saying, hey, you owe money. Here's a reminder. Then they say, we're going to file a lien if you don't pay this. And they record a lien. So when they record it, if it's recorded in San Diego County, it's attached to any real property I have in San Diego County and anything I own in San Diego County, basically. So then if I go to refinance or to sell my house or do anything, that's going to be on my title history. So it's going to be dealt with. The IRS is going to be sitting there in my escrow saying, we want our money. And that's probably a bad time to figure out that you owe money to because if it's in escrow and you're trying to do a refinance or something like that, we can deal with liens, but you still have to deal with it. It's literally a lien creditor. And no, they didn't have to send you a lawsuit and they didn't have to have a judge make that determination to issue the lien. They just record that notice. So they're really difficult. They stick and they're sticky and they're going to get paid. But I love what you're saying but if you deal with it, sometimes depending on the dollar amount, you can actually work arrangements with the IRS in a number of different ways. And the goal really is to get them to get the lien off of your credit report or get the lien off of your record. So then maybe you can refinance or something like that.
Another thing that I might talk about is what's called subordination.
Okay.
Say you want to refinance your home because the mortgage interest rates are much more favorable than when you originally got your mortgage. And the IRS is sitting there, like I said, they're probably under your mortgage lender because it's a priority. It's who filed first type of thing. But once, let's say you want to refinance, and this new refinance is going to give you some additional money every month, like let's say $1,000 extra, the IRS may subordinate their lien and go under the new lender if that extra money will help you in repaying your payments, in your installment agreement, or get into an installment agreement where you use that extra money to pay back the IRS over time. So that's the only way that maybe instead of getting rid of it by paying it off in full or getting an accepted offer or getting it released by paying 3 months of installment agreement and balance under 25. But that subordination is another thing, but that's very, very difficult to get. You have to go through a process, fill out an application, deal with a lien subordination. They have a big office, I believe, in Orange County that you have to deal with, and you get a specialist. I've worked with them on several occasions, and it is difficult, but if it is beneficial to the IRS, they may subordinate it in some cases.
I like that. That's interesting because you can't afford to pay it. But then you go to your lender and they say, we're not going to loan you any money. You have a federal tax lien. But then you, Rich Mathurin, can go to the IRS potentially and say, hey, IRS, if you move out of the way, let this refinance happen. We're not going to get any cash for you because that's a cash out refinance. However, the mortgage payment's going to drop by whatever, $500 a month, and we'll give you that $500 a month, then the IRS will get out of the way and let the refinance go through sometimes.
Yeah, that's generally the way it works. Like I
That's
said, if
interesting.
it's if it works, it has to be something that's going to be beneficial to the IRS from their current situation with you if they do the subordination.
So you're not trying to say the IRS has a heart. You're just simply saying the IRS goes by statute. And if we can show that this is beneficial for the taxpayer, they don't really care, other than there's enough money available now that if the IRS is cooperating, there's going to be money available for them to pay, that you can actually work arrangements with them.
Yeah. And I if you are thinking about refinance or selling your home, I would recommend doing we have title software where we can show the IRS and the FTB liens. You can find them on the San Diego County Recorder's Office, putting in your name and you have to go through all the steps, but you can see, they should show any recorded liens against you or your property.
Well, let's talk about something else. So let's say somebody has a federal tax lien recorded against their property. It's a bunch of money. And our potential client is saying, I'm going to sell my house. I'm just going to sell my house and I'm going to pay off this federal tax lien. What about penalties? I mean, maybe can you sometimes get rid of penalties before? Because I'm just thinking, if you could get rid of penalties, sometimes it's real money. It's thousands of dollars. Do that before you actually go through the escrow. So the IRS is asking for less money. How does that? Can you get rid of penalties sometimes?
They do have a program, what's called the first time penalty abatement, where if you did not have penalties in the prior 3 years to the first time you incurred penalties, and you are making arrangements to pay the IRS through the sale or the refinance, they will a lot of times they will abate that first year's penalty, but you do have to have no penalties the prior 3 years and be the first time you incurred penalties, and you're making arrangements to deal with your tax balance with them. They will abate those first time penalty, and you can get multiple first time penalty abatements as long as you're complying with that. And I also I think it's a 2-year rule. You have to claim it within 2 years of when the penalty was assessed or when it was paid off. There are specific rules, but there is some timing issues on that to claim that.
Okay. So probably the better idea on the penalty abatement is to try to, if you're dealing with a federal tax situation or even a state tax situation, the best idea is to call Rich, 855-500-TRUST, let Rich get the reports to figure out timing. We've seen situations, or I know you have, we've talked about them before, where somebody's thinking, I'm just going to sell my home. I'm just going to get a refinance. I'm going to pay this off. And you say, wait a minute, those are old. And you go and look up and you get a special report, which I want you to mention. And the report shows if you just hang in there for like 3 more months, you're going to have one of these tax years that will literally just go away, then resolve the problem. So talk about, because finding that information, that's really good to know. And the IRS, it's not like you're going to call the IRS and say, hey, IRS, how long do I have to wait before I don't owe you any more money? Talk about this report that you've been able to get.
Yeah, we have a tax software program where when we have an IRS power of attorney, we can access your tax records for like 30 years, and we can show what you owe for each year, what your penalties and interest are, and then what you specifically that you talked about. Once the taxes are assessed, let's say that the taxes are assessed in 2017, the IRS has 10 years from the date of assessment to collect on that. So they would have roughly till 2027 to collect. But sometimes your balances would fall off if you wait a little bit, and you wouldn't have to pay that under the statute of limitations. So it may, behoove you to wait a little bit and get a year or two to fall off. Maybe it's a high balance. And then you sell your home and pay off the IRS with what's remaining, type of thing.
It just seems like knowledge is power. And the reason that's a saying is because it's a real thing. Knowing information, getting information. I represented a gal, this was years ago, and she owed so much money. It was this crazy situation with a divorce, and husband made all this money and he got in trouble, whatever. And we literally were watching for the years to fall off. She had to wait 10 years to get past, but we got a couple of the big years to go away, and then we were able to resolve it. So I just think, the message we're conveying to you listeners is that find out what's wrong first. Get this report that Rich is talking about, You can call in, you can come in, talk to Rich Mathurin, 855-500-TRUST, get this tax report. He can figure out, which which periods are going to fall off. Should you wait? Because sometimes you think, oh, I don't want to wait. Well, if you look at it and you go, okay, if you wait 6 months, you're going to, that $10,000 is going to drop off. Well, that's a no brainer. I mean, of course you're going to wait, but sometimes timing is a big thing. It's not just a matter of, okay, forget this, I'm just going to sell my house. It's a matter of, let's look at it first and see if there's a better plan. You listen to Rich Mathurin and Gary Quackenbush on GQ, on The Word on Wealth. Call us at 855-500-TRUST. If you have a tax situation, call and talk to Rich. Get your free initial consultation, 855-500-TRUST. Rich, as always, thanks for being on the show with us.
Thanks for having me.
All right, everybody, give us a call, 855-500-TRUST. Listen up tomorrow. We'll be back here on The Word on Wealth.
Tell a friend about the Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future.
The information you hear on The Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The opinion